Subsidiary fair value, well, when consolidating and using the acquisition method, same thing. The total fair value of the subsidiary is the parent's acquisition cost. So this is to recap essentially what we've been seeing, right? This is a recap. This is nothing new. This is fair value of subsidiary is what we paid for it plus the NCI at fair value. Just putting it a little bit more into words, right? If this makes sense to you, feel free to skip this slide. It's here. If it's still, you need a little bit more. When one company purchases another, it's the perfect time for evaluation or revaluation of the subsidiary's value, as I mentioned. At the acquisition date, the fair value of the subsidiary must be compared to its book value, the net assets, right? Assets and liabilities. If any questions, there will be a difference between these two, which require a few adjustments, right? So you're going to have a book value different from its fair value. Balance sheet adjustments to the subsidiary's assets and liabilities from book value to fair value. That's what we saw before. We had to write it up by, I believe it was 25 million. Identifiable intangible assets related to the acquisition. This is anything that needs to be recorded at fair value. And goodwill is created from acquisitions when the parent pays more for the company than it's worth, the book value of the net assets, right? If I'm paying $100 million for a $90 million, if I'm paying $100 million for a $90 million company, that's $10 million of goodwill. If you're paying less, maybe you got a deal on it. Like I was saying before, if you get a deal and they agree to sell it to you for less, that's a bargain purchase, which results in a gain. This is a debit to an asset on your balance sheet. This is a credit to an increase on your income statement.